You're listening to Music Tectonics.
Welcome back to Music Tectonics, where we go beneath the surface of music and tech. I'm your host, Dmitri. I'm also the founder and CEO of Rock, Paper, Scissors, the PR and marketing firm that specializes in music innovation. Today, I'm talking with Valeska, Pederson, Hinz, a partner at Perkins Coie, about what's happening in the world of music tech investment. Valeska has extensive experience in guiding companies and investors from Series A to IPO, and as a result, has a notable vantage point. Our conversation's expansive, and it includes the current state of venture capital funding, the impact of generative AI on the industry, and the ongoing legal debates surrounding fair use versus licensing and training data. I think you're going to enjoy it. She's also got some great practical information for startup founders from the legal standpoint of someone who guides growth stage companies. But first, the news.
Rock, paper, scanner.
First, we've got a few headlines I wanted to share. All of them actually come from Music Business Worldwide. Check out Music Business Worldwide. Great, prolific writing. I don't know how Tim Ingham, Murray Stassen, the whole crew there does it. UMG generated $3 billion plus in Q1. The headline stat that the company generated $3.052 billion across all divisions. The Q1 revenue figure was up 9.5% year over year at constant currency, driven according to UMG by solid growth in recorded music and music publishing. Meanwhile, another report, Spotify posts record high operating profit as well, growing premium subscriber base to 268 million paying users in Q1. That's according to the company's latest financial results. And they're reporting premium subscriber base was up 12% year over year, up to 5 million net subscribers on the 263 million that Spotify counted at the end of the prior quarter. So growth from labels, growth from streaming services. There were just a couple of acquisitions that I want to mention before I dive in with Tristra on more detailed news. Splice acquired Spitfire Audio for reported $50 million as it bets on AI music creation. So that's a super interesting development there. And Epidemic Sound acquired AI startup Song Sleuth to tackle music's black box problems. Song Sleuth is an AI music recognition startup betting on AI to solve one of the music industry's most persistent challenges, tracking and monetizing songs used in user-generated content online. So a few headlines I just wanted to share as we dive in. I've got with us, as always, the Chief Strategy Officer at Rock, Paper, Scissors, Tristra New Year Yeager, to dive a little more deeply into some other trends we're spotting and conversations going on. Hey, Tristra.
Hey there. How you doing, Dmitri?
I'm great. There's so much happening with all these reports of revenue and all these acquisitions. There's a lot moving, but there's some opinions out there that I think you spotted.
Yeah, it's earnings season, so there's lots of news around that, but there's also the reaction to earnings season, which is always exciting. So for instance, Spotify's Q1 growth didn't hit the same way with everybody.
Uh-oh.
David Israelite of the NMPA attributes Spotify's Q1 growth, according to a piece in Music Business Worldwide, to their bundling maneuver, which of course lots of publishers and other rights holders find a bit, I think we could put it very diplomatically and say that they find it a little bit distasteful. So if you don't remember the bundling kerfluffle, when Spotify began to add audiobooks into the mix, they argued for lower payout rates for publishers, and that has not, of course, sat well with publishers. Another great David Israelite repartee or salvo in the ongoing question of, is music for AI training considered fair use? Jack Dorsey had a pretty, and I'm sure he knew he was doing this, a pretty inflammatory post, skeet, tweet, what do we call them nowadays? Like thingy on X.
Skeet? Did you say skeet?
I don't know what we call it. An exclamation that simply said delete all IP law, which for someone who's super wealthy feels a little disingenuous for him to be asking for everyone else to basically give up the source of their business and wealth.
So as an inventor, David Israelite points out that that Jack Dorsey has benefited from IP law as he got his inventions off the ground.
But yeah, Jack Dorsey really did not please people whose businesses are based on IP with that statement. And then David Israelite, if you check out his opinion piece in Music Business Worldwide again, sorry, MBW, we're just like we're fangirling and fanboying on you this week.
We love MBW.
Yeah, they're amazing. But this piece is great. And I always get excited whenever David Israelite speaks up or has an op-ed because they're always really lively reads.
I think we might need to get a David Israelite audiobook, like a sound logo on Music Tectonics. Whenever he has something to say, we have to have a special. I don't know. Is it like a knight in shining armor, or is it like a Darth Vader-esque kind of thing?
Oh, no. I think it should be like a klaxon, like a DJ Khaled-esque like air horn. That's what he means to me. Just like he's like, another one. I'll never forget him walking out to Mama Said Knock You Out by LL Cool J a couple years ago.
Song.
Yeah, that's
if only we could license that to play it onto Spotify. We could use that.
I'm sure there's a way, or if there's not a way, I'm sure someone out there is working on it. And one more little thing I wanted to note in that sort of reaction to Spotify's Q1 growth. Deezer just announced their Q1 results, and they also grew modestly due to increased subscribers. So I don't know if we can really attribute all of that to bundling. I think we're still seeing some growth all around, and everyone's benefiting from it, even the smaller players.
I also wanted to point something else out that he brought up that came up in that article too, which is the three major publishing arms have all, I think 3 of them, maybe 2 of them, have done direct deals with Spotify that supersede that audiobook bundling issue. So in a way, there's some interesting arbitrage going on there for those that are non-major published songs in terms of payouts to songwriters and publishers. They're not represented by those majors because of those direct deals that supersede that. So it's complicated, and it's very political as well.
Absolutely. So something that's a little less complicated and is working behind the scenes in the music industry is this interesting trend to rethink distribution and to move away from the purely sort of digital pipeline and the quote unquote hustle that many artists feel that they have to engage in to promote their music and tour, etc. I found this really wonderful article called Tune In, Drop Out from Hearing Things, which is a fantastic new music outlet. I encourage everyone to subscribe and at least to get their free newsletter, which is awesome. And they have pretty good taste. And I'm a snob.
Hearingthings.co. It says.
There we go. So anyway, back to the article.
Drop out the independent musicians and labels who are saying no to streaming.
Yeah, and that's a little bit of a clickbaity, that's a little bit more over the top than the artists themselves. But what they're trying to do, and there's a bunch of anecdotal, very fun stories in there about different distribution methods and very handmade or community-based distribution. And the whole idea is not to hit the numbers, not to game the algo, but to create things that are an extension of what your musical sort of ethos already is. So if you're someone who feels really connected to an artistic movement or community, you distribute through that community in often a very sort of localized way. And one artist that they interviewed, I loved this. She was hustling. She was like doing all the things, right? She paid someone to do her PR, etc. But then she realized that her music was more of like, she wanted to do house concerts. She wanted to do something more intimate where she could feel a more close connection to the audience. And so she changed her whole distribution strategy. And with the overall interest in direct to fans, whether we're talking super fan apps or places like Stationhead, where, fans and artists can interact more closely, more humanly, or whether it's, I am going to cut your vinyl right here and print the cover in front of you and hand it to you. I think all of those things are pointing to a really deep reimagining, rethinking that a lot of artists are doing of how they reach fans and what it means to be an artist in an artist-fan relationship. I think it's exciting. I think we're going to see a lot of creativity around these questions.
Yeah, it changes the question about using tech platforms for scalability and more about what is my connection with my immediate circle of fans, my supporters? How can I strengthen that quality over quantity and really feel more connected to what ultimately marketing is doing, which is building community?
Yeah, it's really cool to see. So I really recommend reading that article in full and checking out the examples and sort of seeing how people are getting creative. Ideally, marketing and distribution and PR should be an extension of your creative process and not like these extra weird tasks that are these appendages you have to slap onto your creative core.
And it's a reminder that like being in the nosebleed seats at a $200 or $400, $500 ticket concert is not the same experience as being at a house concert where you're like, you literally get to meet the artist, you get to see interactions up close. Just from an experience, if we're talking about fandom and super fandom and VIP experiences, you go direct to VIP. You don't have to grow to a certain size to have the VIP experience, and it doesn't cost as much. Now, of course, this is not a house concert. Well, it depends, actually. I was going to say a house concert doesn't necessarily make tons of money for an artist, but if it's the right artist and the right fans, it actually could.
And it can make more than what you'd make from 10,000 streams, which can be really hard to achieve if no one knows who you are and you don't have a very established fan base. The other thing that's interesting too is as a music lover, hearing someone perform right near you in close proximity, you're sharing the same space, you can maybe even make eye contact. That's so different in terms of discovering new music. And that's like a whole other thing. Like, yeah, I understand people going to a Taylor Swift concert because they all want to sing along. And that's a whole other thing. But if you've never heard Taylor Swift, is that really the best way to hear her in an arena with a huge flashy show and lots of crazy people around you? I don't think so. And maybe not all artists want to do that. Maybe that's not really, some artists are just there for the pageantry, right? That's cool. And that's cool too. But if you're an artist with something to say, people are going to discover you, and you're going to hear the music so differently as a music lover if you're right there and able to really feel the humanity. So yeah, it's a fun, thought-provoking article.
Yeah, Tristra, always love you bringing these great pieces from the big picture stuff to these community-oriented things that are happening. It's a blast talking to you. If you want to get this type of news in your inbox every Friday, sign up for the Rock Paper Scanner. You can go to rockpaperscissors.biz and go to the contact page or the resources page, and we'll sign you up. People like Graham Harrison, general manager at Blue Sound, tells me he takes his hike up the hill every day listening to the back episodes of Music Tectonics. People like Jason Wilbur with Coordinate shouts us out on LinkedIn and is listening as well. Really appreciate all the listeners. If you're listening, hit me up on LinkedIn. I'd love to shout your name out on the podcast too. Tristra, this has been a blast.
It's been awesome, Dmitri.
Now for our feature interview.
As a partner at Perkins Coie, Valeska, Pederson, Hinz helps close the deals and navigate the challenges that are part of the journey from Series A to IPO for companies and investors. Having worked on multiple unicorn deals and over a dozen IPOs, Valeska brings unparalleled expertise to her clients. She acts as the first point of contact for growth stage companies, helping management teams establish corporate and governance structures that enable their long-term success. For investors, Valeska helps shepherd their investment process and provides strategic advice on acquisitions, IPOs, tender offers, and other liquidity events. Valeska, thanks so much for coming on to the Music Tectonics podcast.
Thanks so much for having me. I know this is boring, but just a quick note before we dive in. I am a lawyer, but nothing I say here should be taken as legal advice. Just information, hopefully useful, maybe even interesting, but if you're facing an actual legal decision or anything involving real money, you should really talk to an attorney who's licensed in your jurisdiction and understands your specific situation. Also, I'm expressing my own opinion here and not those of my firm. And with that out of the way, a huge thanks to Dmitri.
You would say all of that.
I know.
And you have to. And it's good that you do because people should know what's going on here. So thank you. I'm excited to talk to you. I saw you do a presentation in Austin where you're based during South by Southwest, and I learned so much about the investment landscape. And even you guys dove deep into what's happening with music tech. I really appreciate you doing that presentation. And I hope to share some of that on this episode. How is the VC landscape looking overall in this first half of 2025?
Not as great as I had hoped.
Oh.
According to TechCrunch, startups have raised about $91.5 billion in venture funding in Q1 of this year. So that's an 18.5% increase over Q4 2024 and the second highest quarterly total in the last decade. And on the surface, that sounds like a rebound. So it sounds like better than where we were when we last talked. Like maybe the vibes are back, right? Nearly half of that money, 44%, came from a single deal, OpenAI's $40 billion raise. That's the company behind ChatGPT and a lot of investor FOMO. So not exactly a sign of a broad-based enthusiasm. And according to PitchBook, another 27% came from just 9 other companies, including Anthropic, another AI research company building large language models like Claude, which raised $4.5 billion. So if you strip out those mega deals, the rest of the market, literally every other startup shared about $26.5 billion. That's not nothing, but it's a long way from a market-wide recovery I was hoping for.
Whoa, that's really interesting. See, already I'm like getting insights about stuff that I wouldn't catch in the news myself. I mean, I knew a lot of these big AI, Gen AI companies were attracting a lot of money, but to think of it that way, that there's like a handful of whales that are really soaking up all the oxygen in the room from investment does paint a different picture. So historically, let's focus in on the music tectonic side of things. How have investors done with music tech investment? Because I think you have some context there that's really useful for our wider audience.
Yeah. And what we'd been talking about before, historically, music tech has been a tough category for investors, and the data backs that up, right? According to tracks, as of earlier this year, there were over 10,000 music tech startups globally. Of those, about 1,800 were funded, raising a total of $15.5 billion. But when you look at the exit data, it's only 239 acquisitions and just 20 IPOs. So you start to see the challenge there. As of last month, you can add one more to that list. Infinite Reality acquired Napster for $207 million. So that's great. But what really jumps out when you drill into the numbers here is the difficulty of music tech startups face in reaching scale. And remember, we had that chart that showed like, here, he's funded companies based on their round. And when you looked at it, only about 20% of the funded companies actually make it to their Series A, and just 4% reach a Series C, and only 2% reach the later stage rounds, like a D or beyond. That's fewer than 50 companies, and that's where your billion-dollar unicorn valuations typically start showing up. Now, those stats really matter because venture capital is built on what's often called venture math. Investors aren't just looking for good businesses. They're looking for the 1 out of 10 that can return the entire fund. So for VCs, that means aiming for 10x returns. Growth equity investors may target 5x returns, and private equity firms often look for about 3x. But they have lower risk and more predictability in the growth and private equity. That's because they're dealing with later stage companies. So to even get in the door for a Series A, your business has to show the potential to reach that kind of multiple. And historically, compared to enterprise SaaS or fintech, music tech just hasn't produced many unicorns. That makes it harder to raise institutional capital in this space unless you can clearly demonstrate scale potential and a credible path to liquidity. Those later stage rounds are typically where you're getting the billion-dollar valuations or unicorn status, like Pandora going public at $3.5 billion. Venture investors need to believe that type of return is possible before they want to invest in your company. It's not that investors haven't made money in music tech. They have, but the bar is higher from what I see, and the exit paths are narrower. So the expectations are steeper. So when you have a music tech company break through, unfortunately, it's the exception and not the rule.
Wow, it is sobering information when you present the data that clearly. And probably there's some music tech founders out there listening to the podcast who just felt pain in their side or in their stomach or something from just hearing the data just put out so clearly. I guess I could ask this question. I don't know where we'll go. I'll be curious to see what you say. What are the pros and cons of music tech as an investment category?
From my perspective, music tech, like any tech category, is most compelling when it's undergoing a disruption cycle, right? That was the case in the early days of streaming, starting with Napster, evolving into your platforms like Spotify and Pandora. While streaming services may still be innovating, it's now more of a mature market segment. So today, the disruption is in generative audio, voice modeling, AI-powered production tools. I keep hitting AI. This whole thing is going to be AI. One clear pro, though, I think, just for the sector in general, is that music tech has cultural gravity. And in a way that other sectors don't outside of like media tech, like film tech. People form emotional connections to artists and music brands in a way that just doesn't happen with enterprise software. No one's forming a fan club for invoice automation. But millions of people, including my 6-year-old, follow Taylor Swift, and lots of people like the Rolling Stones. It's fun, it's public facing, and when it scales fast and globally. One of the drawbacks is that, like we're talking about, the exit funnels narrow. As we discussed, there's a lot of early stage bets, not as many acquirers, and only a few of the startups reach the kind of scale that attracts real M&A attention. And there can be some regulatory risks, which are often overlooked. So I guess when you have an attorney on, they're gonna bring this up. But one example is some music tech startups have been trying to innovate around artist financings by offering investors a cut of future revenue. Think streaming, touring, merch, whatever. The problem is that these models can raise serious red flags down the road. If the arrangement starts looking like credits extended to a musician, it may trigger lending laws. And nobody would normally think of that. It could also look like pooling investor money into a common enterprise. And if you think back on all the Web3 blockchain,
NFT,
securities, Howey problems, you're getting into that space because you're tying all of this pooled money into a common enterprise that's tied to future revenue. And that startup starts becoming to look like an unregistered investment company under the Investment Company Act of 1940. That's something nobody's really thinking about. So those are issues that often don't surface until it's too late. And when the company is scaling and they're trying to borrow from a bank or prepping for an acquisition or an IPO, at that point, the damage can be really hard to unwind. So banks won't lend, buyers walk, even your contract rights can be void if you're found to be an illegal investment company. So the takeaway, though, is that these startups in these situations, they need to pause when they're initially structuring the investment arrangement and engage regulatory counsel, which isn't me. There's lots of them on my team. But if you wait until you've grown and scaled the business, it's maybe too late to fix the issue.
You do sound like a lawyer. I mean, a nice lawyer, but you're giving us helpful tips in advance. But yeah, there's a lot of categories you just came up with there that do complicate just thinking through some of the legal speed bumps or worse along the way in the future. That if you don't think about them now, they can get a lot worse. Okay, I'm going to keep going with these questions. What investment categories within music tech have done better than others?
So based on data from PitchBook, the music tech categories that have attracted the most capital since 2020 are those that intersect with a broader proven business model. So the top three are movies, music, entertainment tech. It's probably not a surprise to you. And that's with over $350 million in invested capital. And then you go to entertainment software. That's close to $300 million. Then the third is business and productivity software. A lot of software, right? And that's with over $250 million. A distant fourth is going to be B2B, that's business to business media and information services, but that drew only about $75 million. Beyond that, the numbers drop off like really sharply. So from an investor lens, the categories that do best tend to either support content creation and distribution models at scale, or they offer tools with enterprise or cross-sector utility. What's also notable is how the themes have shifted. In 2021 to 2022, a lot of attention went into metaverse concerts, blockchain-powered royalty platforms, avatar-based artist models. But in 2024, it's more boring stuff. And we've seen a pivot towards more traditional and arguably more scalable businesses. So for example, Hellman and Friedman, which is also called H&F, easier to say, had a $3 billion investment in global music rights. And Universal Music Group did a $775 million acquisition of Downtown's distribution infrastructure. That reflects significant interest in rights infrastructure and distribution. So not the flashy metaverse concerts, but a little more stable. And then at the same time, I think the biggest story kind of across tech generally, like I've been saying, is AI. So AI is clearly driving the next wave of excitement. Two of the most talked about deals this year were Lightspeed's Series B investment in Suno and Connect Ventures' $40 million Series A in Music.ai. And Music.ai is a foreign company. It's kind of interesting. Both are AI native platforms focused on music creation and production tools. One is more consumer facing and the other has a strong B2B offering. And both were backed by major global firms, both with billions of dollars under management. So Lightspeed has $28.2 billion under management, and NEA, which is a partner in Connect Ventures, has $25 billion under management. So these are huge venture firms that are big players in tech, really well known globally. And what these deals have in common is a bet on scalable technology, not just cool features. It's not just a product, it's an actual scalable business. So the platforms offer real utility for creators. They're paired with commercial models that can expand across industries and geographies. And in the case of music AI, the emphasis on ethical training data also addresses kind of one of those key risk factors in AI, which is IP compliance. So while the exit funnel in music tech has historically been narrow, the categories gaining traction now are those that solve real problems with business models that grow and adapt, particularly where AI and music creation intersect.
Again, that data really, I think, gets us quickly educated on the different categories, some of the considerations, both in terms of historical interest as well as current interest as well. So thank you so much for that. That was super helpful. Maybe like moving, I don't know if it's more anecdotally, but what are you hearing from the investment field about investing in music tech right now? I know you're not necessarily a specialist in that particular vertical, but I'm curious, with your knowledge, with your lens, now that we've looked at some of the data, what are you hearing?
Yeah, right now, most of the buzz I'm hearing around AI-powered music tech. Last week, I served as a judge at the Rice Business Pitch Competition. And to give you a bit of a background on what that is, it's the largest, best funded collegiate startup competition in the country. So think of your PhD students at Stanford, Harvard, Berkeley, all across the world, and your college students. And they got 550 domestic and international applications that they whittled down to 42 teams. And those 42 teams competed, and 2 of them were in music tech. And that's something I haven't seen before. And I think it's a sign of where things are headed. One of the startups was this company called Songscription out of Stanford. They use AI to transcribe audio and music sheets and automatically arrange songs for different instruments and musicians. They do some other things. Another one was Watermark.ai from UIUC. They embed imperceptible digital watermarks in songs, podcasts, and other audio files to protect them from deepfakes and unauthorized use. So cool things. And these are really they're college students and PhD students. So these are early stage companies. But often the most exciting innovations come out of universities. And in my opinion, it's really encouraging to see music techs holding their own in competitions usually dominated by energy, healthcare, and SaaS. On the investor side, Yamaha recently launched a $50 million music tech investment fund. It's the first through the Yamaha Music Innovation Initiative. The fund's focused on backing innovation across the entire music value chain, from production and recordings to streaming and fan engagement. That kind of corporate CVC or corporate venture capital commitment signals a growing interest in the investment sector, I think. I mean, we see a lot of CVCs in tech, but it also has broader strategic view of like where music tech is going to fit in the future of content creation and consumption. So I see those 2 things to me stand out as like really interesting.
Those are great stories. Thank you for sharing all that. As I listen to this first half of this conversation, Valeska, I'm thinking a little bit about some conversations we've heard from a lot of people in the investment side of things. One, that a lot of investors don't think of music tech as a category, and their advice is think more transmedia, think across larger verticals, bigger markets than just music tech. So some of the statistics that you shared with us, I think kind of point to that. And when you talk about entertainment as one of the biggest categories, and film-related things that are also music-related as one of the biggest categories of investment in the past, that points to how a music tech company could widen out the possibilities, not only by looking for investors who are like changing your mission because there's investors in it, but also widening out what the potential customer and the potential market is for that company as well. So that's an interesting insight that I think resonates with other things we've heard on the podcast. But I'm excited to hear you talking about some new categories that are emerging as a result of some shifts, certainly the AI stuff around music creation, regardless of whether it's Gen AI or not, whether it's ethical or not, but just the fact that there's this infusion of interest around music creation with these tools. But also, like some of the startups you mentioned too seem to be in response to some of the challenges that were in the past. Things like watermarking music in itself is an interesting one too, to protect against deep fakes. Like you can have AI as the solution in music. You can also have AI as the problem, and then another form of AI that solves the problem of AI in music as well, such deep fakes.
It's interesting, the AI and deep fakes, because I was playing around with the Suno app, And we have this cat that we call the asshole cat. I love this cat, but he opens doors and he's crazy. And so I asked Suno to make me a song about this cat, and I put his features in there, and I wanted it in jazz. And I swear it sounds like Michael Bublé. And I love that Michael Bublé made a song about my asshole cat, but I'm sure he doesn't.
I know. And maybe he did. We don't know.
Maybe he did. Maybe he licensed it to them. I don't really know, but it's fascinating what the technology can do. That's just fun for me. But imagine you're a cartoonist and you're like a college student or somebody getting into the field, and you're like, I don't write music. I don't know how to do it. I'd like to just use one of these things for my theme song. And you can do that. And that to me is kind of amazing. So it just opens the world of creation and innovation up for more people, and it makes it more accessible. And I think there's going to be more and not less content created because of this stuff.
This whole conversation about fair use and licensing training data is one that I want to dive into. We have to take a quick break, and when we come back, I have some more for you. We'll be right back.
Music Tectonic's early bird tickets are on sale now. Head over to musictectonics.com to get yours before the price jump on August 19th. Will I see you in Santa Monica at the best music tech conference of the year?
Okay, we're back. And Valeska, I do want to ask you about Gen AI and this fair use versus licensing training data debate and the impact on investment. But before we get there, I want to ask you a little bit something more broad for our startup founders who are thinking about investment. What KPIs are most important for startups to demonstrate to investors?
So that's a great question. And there's so much debate between like CFOs and other people at the company as to what's an important KPI. And the reason that is because KPIs are really specific to each company. They depend on your business model, the dynamics of your market. A B2B SaaS startup is going to track different metrics than a consumer-facing marketplace, and music tech has both. That said, across the board, investors are prioritizing revenue durability is something I've heard a lot about. In the past few years, the focus has shifted in tech generally from top-line growth at all cost to long-term resilience. And the KPIs that matter most are the ones that show your business can scale sustainably and withstand market volatility. So some important KPIs I'd like to highlight are, number one, churn and retention. So that is, are your customers sticking around? Churn is the rate at which customers stop using your product. So that's an important one. It signals fragility. Strong retention points to lasting value and product market fit. I'm sure you've heard a lot about product market fit from startups. Number two is what people call LTV and CAC. So LTV, that's lifetime value, so total expected spend per customer. And CAC is customer acquisition cost. And this is really getting at, is your growth cost effective? And sometimes what you'll see is people will look at the ratio of lifetime value or LTV by customer acquisition cost or CAC. And what that tells investors is whether you're building a scalable business or just burning their money to grow. If you earn $1, but it takes you $2 to get that customer, not so hot. The third thing is revenue mix. So that is how balanced and reliable is your income or revenue. So investors are going to look at how much your revenue is recurring, and that's things like subscriptions versus transactional, whether it comes from a single segment or multiple segments. So think of customer types, geographies, product lines, and how much of it is tied to consistent behavior, reoccurring things versus one-time events. So at the end of the day, investors are backing companies with predictable, repeatable, and resilient revenue, not just those that are fast growing right now. And to build that kind of company, you need to be able to track the right KPIs from the start. So I love your question because KPIs aren't just for fundraising. They're really part of how you build a staying power in your business.
I know a lot of our listeners were taking notes and are rewinding this and catching notes on this as well. That was great. Valeska, you're really good at crystallizing some of these answers into like very condensed but useful information that I'm sure people are going to be studying for weeks and months to come. So thanks for that. You and I talked about this when we were in Austin, but also just through this conversations, it's clear that you're aware of what's going on in the Gen AI and the music field closely, specifically. There's a debate about fair use versus licensing training data, which fair use sounds so fair. But I mean, you mentioned some of the legal challenges of having some type of company that is skirting some laws around IP. How does this debate impact investment in AI and music? Is this if you follow the fair use doctrine or perspective, then that means your expenses are much lower because you don't have to license things. And so you can grow like crazy? Or are you potentially facing the type of lawsuits that could put you out of business with multi-billion-dollar fees, just losing all that money in legal cases because you haven't followed the kind of the regular practices around using other people's IP? How is investment influenced by AI in music?
Yeah. So just to start off with, here's my second disclaimer. I'm not an IP attorney, so this topic isn't my specialty. That said, the area is unsettled. It's really complex. And it's quickly evolving. So I'd just like to back up for a second and give a little bit of a picture of the landscape. So generative AI models, I'm sure most people know, but they need massive data sets. So think text, audio, images, and they use that to learn patterns. But if those data sets include copyrighted material, like songs or lyrics, the question you're really asking is, do AI developers need permission to use them? And can they rely on fair use, like you were saying? There's a separate question of these companies that have websites also have terms of use, and those are contracts that govern how you can use things. And if you're using in violation of that, you're in violation of contract law, and that's a breach. But we're going to put that aside because we could talk forever about this stuff. But the question is now at the heart of multiple lawsuits with respect to AI, and is it fair use? The most recent case that I feel like has gotten, or there's two of them really. There's the Thomson Reuters versus Ross Intelligence, and there's Concord Music Group versus Anthropic. And both of those highlight a growing legal conflict between what we were saying is the fair use doctrine and the emerging practice of licensing data for AI training. The outcome of these cases is still unfolding. These are still ongoing. And so it's creating a lot of uncertainty for startups, clearly, especially in music tech. And it's influencing how investors evaluate those companies and how they value them and how they diligence them. So these are like very important topics. We'll start with the Reuters case. So the Reuters case was the first major US court decision on AI training and fair use. Ross built basically an AI legal research tool and trained it on summaries of case law derived from Westlaw's database without a license. And for attorneys, we're really familiar with Westlaw. They use these like key sites, and we learned how to use them in law school. So this kind of rings a bell for us. In February 2025, the court rejected Ross's fair use defense and ruled that using Westlaw's copyright headnotes to train its AI was infringement. So for context, the doctrine of fair use provides that use of another's work is not infringing when it's used for certain purposes. And there's not really a black line rule for what that is, one of those facts and circumstances tests that lawyers love to talk about. But when you're determining whether a particular use is fair, the courts are going to consider 4 non-exclusive factors. So one is the use's purpose and character, including whether it's commercial or nonprofit. 2 is the copyrighted work's nature. 3 is how much of the work was used and how substantial a part of it was relative to the copyrighted work as a whole. And 4 is how the defendant's use affected the copyrighted work's value or potential market. Now, the judge in the Reuters case dismissed the fair use defense as a matter of law. That means it doesn't even have to go to trial. It's just settled. And the reason that was is because Reuters had problems with factor 1 and factor 4. The judge noted that Ross Intel's tool wasn't generative. It's helpful in this case. They returned existing text rather than creating new text. And it directly competed with Westlaw. So the use wasn't transformative and it was direct competition. The decision marked the first time a court squarely held that feeding copyrighted material into an AI without permission was not fair use. And the lawsuit was actually such a financial burden that the company went under. So that's like the first example. The second one is that Anthropic suit. And here what we had was music publishers, Universal, Concord, etc. They sue Anthropic, which is the maker of the Claude AI chatbot. And what they alleged was that Claude was using song lyrics in training data without permission. So in March of this year, the publishers sought a preliminary injunction to stop Anthropic from using their lyrics. The judge denied that, which some people said is an early victory for AI companies, but really it was a limited win. The court didn't rule on the ultimate issue of fair use. So it just found that the publishers hadn't shown immediate irreparable harm. And that's what you need for an injunction. So the judge's ruling emphasized the existence of a market for AI training data licensing. And I think that's more important than just saying there wasn't irreparable harm. So what she did was point out that music publishers can license their catalog to AI companies for training. So that's like an emergent market for licensing. And to me, that's not, if you're pointing that out, you're not saying clearly you can just use this as fair use. I think it's part of why you're starting to see startups like music.ai tout their ethical training data, which is licensing the copyrighted data that they're using. The judge also in the Anthropic case explicitly noticed that she wasn't deciding fair use at that stage, but her comments I just don't think they bode well for the future of using the fair use defense in such cases. So the case is ongoing, but to me, it signals that music AI developers face serious questions about using unlicensed content. And these cases, what they really show is that the legal landscape is in flux. So on one hand, you have these tech companies that are arguing that ingesting copyrighted works to teach an AI is transformative and should be fair use. On the other side, you have content owners insisting AI training is just like any other use that requires a license, especially if it threatens their licensing revenue. So battle's not over. Lines have been drawn. You're going to see more lawsuits by authors, artists, media companies. They're queued up. But these aren't Supreme Court rulings. So it's not a settled issue. And the discussion doesn't even touch on what I was mentioning before about terms of use, more like contract breaches from pulling data and how you're using it. So, there's the question of ingestion. Can you use these copyrighted materials? And then there's also, once you create the content, who owns it? So there's so much that is a moving target right now. But it's a really interesting field. So before, again, to my point that I was raising, before you really start diving in and creating all this stuff and training your model and get to the point where you're ready to scale, you really should be talking to an IP attorney and figuring out, how do we work in a way that makes us a sustainable long-term company? Because you need to be able to sell your company. You need to be able to take it public. You need to be able to borrow. So you don't want to get to a place where you've scaled and you can't do those things. If you're not in it to win it, I don't know why you're here if you're in the venture space, I guess I would say.
That was super helpful to get a very well-expressed summary of some of the things that are going on in the courts right now around Gen AI and this fair use versus licensing training data debate, even though it's still in flux and we don't know what will happen next or if and when it gets to the Supreme Court, what some of the final decisions will be there. But interestingly, it is in contrast to the data you presented at the beginning around where money is actually getting invested in tech and in music tech specifically. And I guess I might just ask a little more obviously.
Well, not really, right? Because you had those big investments in content libraries. So that means that the big player, your boring, stable private equity guys that make smart, informed decisions are buying content libraries. So to me, along with that Anthropic case, I think that the market is making big bets on content having more value and having more way to your durability of revenue, more ways to create different license streams from different customers, different segments, I think that's all great. So I think it does align.
The only reason I said maybe it doesn't align is because there's also these multi-billion-dollar investments in Gen AI companies that are going down the fair use pathway. Am I wrong?
I don't know all of their licensing models. You're not wrong. But I think you do see some, when you have an emerging industry, and now everybody is thinking about fair use. 4 years ago, we weren't. And so they were developing these models. They've developed over time. People have been thinking about it. So you had the same thing, totally different industry, but just for an example, blockchain had that problem where they threw out all these tokens or all these offerings, and the SEC came after them and said, everything's a security. And it was the same problem. You had an industry that was really trying to innovate, and it just didn't work with the existing framework for various different reasons. Like, these things really did look like securities in a lot of ways, but you were selling them. And for you to be able to create this ecosystem, you needed to be able to send the tokens to various ecosystem participants. And so they did. And so you have a similar thing here where the innovation has really outpaced where the law is. And so you have to figure out, okay, here's where we are today. And this is just a policy argument, and this is just me thinking. But I think you have to stop and say, okay, well, there's these big companies that have trained these huge models this way, and they've created this. What do we do about what they've done in the past, and how do we fix that? And then what do we do going forward? Like, how do we build on this? We don't want to throw the baby out with the bathwater, but we need a fair solution that works for all the parties. And that's really hard to do. And I think that's why you see competing interests where you're right, people are investing in these big generative AI companies, but the fair use doctrine, and this is this year, Dmitri, just a couple of months ago or last month in one case. So it's just new. And I think everybody's just trying to sit down and figure out what makes sense? How do we move forward? What are the courts going to do?
Thanks for diving into that conversation. There's a lot more we could say about this, and it's still unfolding, so we'll see. But now that everyone's heard you talking about all this stuff and starting to get a little bit of sense of how you're involved with it, let's get a little more specific there. How does a law firm like yours get involved with startups and investment, and how far along do companies need to be to enlist your help?
So at a large global law firm like mine, we're built to support high growth companies and their investors through every stage of the journey, from formation to IPO and beyond. I work across sectors, so tech, biotech, consumer products. What I'm really focused on is companies that are backed by institutional investors. Generally, it's private equity, venture capital, and bigger family offices. So whether it's the Series C startup laying its foundation or a late stage company preparing for a public exit, I'm often the first call when the founders are setting up governance, structuring their next round, or thinking strategically about growth. And I've worked on multiple unicorn deals and over a dozen IPOs, so I've seen firsthand what it takes to grow and operate at that level. On the investor side, I represent venture firms, private equity funds, and family offices, helping them evaluate the opportunities they're looking at, structure investments, and execute complex transactions. Because of the scale and reach of my platform, I'm able to tap into deep subject matter expertise. That's things like privacy, generative AI, looking at regulated product counseling, international expansion. So clients get full spectrum support. Interestingly, I also partner with an internal team that we have that goes beyond traditional legal services. So our startup and investor services group helps our clients refine their pitch decks and connect with investors. And that is without cost. That's just a free service. It's a value add. That team's entire job is to maintain deep relationships with venture capital firms, family offices, and private equity investors, and to really understand exactly who's investing in what, at what stage, and in what sector. So it's a valuable resource for both founders and investors. As for when to bring us in, firms like mine aren't always the most cost-effective solution for every task, especially at early stages. And when the stakes are high or the issues are complex, entering the US market, raising capital, conducting a tender offer, navigating delicate board and stockholder situations, prepping for your IPO or an acquisition, negotiating major commercial deals, undergoing regulatory review of your product or services. That's where big law firms really bring the most value. So no matter the stage, my focus is always the same. Clear, business-focused advice that helps clients make smart decisions and keep building.
So one last question, Valeska, before I let you go. You've covered a lot of territory here, and would love to see what you're thinking is coming next. What's the outlook of music tech investment for the rest of 2025? I know it's a tough question, but just wanted to put it out there.
So when we talk about the outlook for music tech investments in 2025, we can't isolate it from the broader venture capital landscape, which is facing serious headwinds right now. So macroeconomic uncertainty, tight capital, and a frozen exit environment are shaping investor behavior across all sectors. And music tech is no exception. Looking into the rest of 2025, the outlook is challenging across the board. There's real uncertainty out there. So think geopolitical risk rising, including early stages of a trade war. Yes, equity markets are volatile, but what really rattled investors recently was the bond markets. So when treasury yields start moving fast, it signals uncertainty about inflation, interest rates, and basically the cost of money. And when money gets expensive or unpredictable, venture capital tends to hit the brakes, especially when there's no clear path to liquidity. How do you value a private company in that environment, especially like a late stage unicorn? The IP window for now is shut. You had Figma, which makes collaborative design software filed confidentially, but others like Klarna, the Swedish buy now, pay later fintech, and Hinz Health, which offers digital physical therapy, have both postponed their offerings. M&A activity isn't really filling the gap either. Without exits, there's no liquidity for limited partners. Those are the folks who invest in the venture capital funds. And that means the general partners, the people running those funds, can't raise new capital to deploy. So if you're a founder building the next AI-powered music tech platform, that Series A check might be a little slower and smaller than you'd hope for, or it may not come at all. Unless we're seeing a meaningful shift, like a pickup in IPOs or acquisitions, we're really likely to see, unfortunately, more down rounds where startups raise at lower valuations than their previous round, more distressed M&A, and in some cases, just plain shutdowns, which some VCs have been predicting for a couple of years now. If the broader economy slips into a recession, the risk only gets worse. So look, the VC market is cyclical, and investors, by their nature, are optimistic. They have to believe that the future is going to be better. That's like the whole premise of investing in innovation, right? So some of the most iconic companies were built in downturns. Remember, like Airbnb and Dropbox were born during the 2008 financial crisis. Spotify scaled during that same time period. Uber, Instagram, and others emerged from similar environments. So keep in mind that during financial crisis, and more recently in the tech post-pandemic period, layoffs resulted in a bunch of seasoned operators using that as like a reset to launch their companies. And those were companies they'd probably been thinking about for years. These weren't your first time people starting out. They weren't guessing at product market fit. They were veterans solving problems that they knew from the inside. So to me, these moments demand focus and discipline and creativity, which is exactly where founders shine. And I kind of want to leave you on a high note with music tech. There's real opportunity. AI is opening up new frontiers in how music is created, produced, and monetized with tools that can make the industry more accessible and artist-centric. So now is the time to be scrappy and build towards those KPIs we were talking about that show durability and value. To stay close to your users, don't wait for the market to bounce back, and build what defines the next cycle. In some, yes, it's a tough moment, but it's also a moment to build. And I think the next wave of meaningful innovation is already in motion. And now is the time when the next unicorns are going to be built.
Wow. Plus, Valeska Pederson Hinz says that music's cooler than the rest of tech. She said it here on the Music Tectonics podcast, and everybody knows it. Those family offices, every time you come across them, you got to remind them how cool music is for us. Okay,
I will
Valeska?
have to do that.
What a great interview. Thank you so much for coming on to the Music Tectonics podcast. Valeska's a partner at Perkins Coie and really great at articulating so much great information so clearly. Thanks for being here.
Thanks for having me.
Thanks for listening to Music Tectonics. If you like what you hear, please subscribe on your favorite podcast app. We have new episodes for you every week. Did you know we do free monthly online events that you, our lovely podcast listeners, can join? Find out more at musictectonics.com. And while you're there, look for the latest about our annual conference and sign up for our newsletter to get updates. Everything we do explores the seismic shifts that shake up music and technology, the way the Earth's tectonic plates cause quakes and make mountains. Connect with Music Tectonics on Twitter, Instagram, and LinkedIn. That's my favorite platform. Connect with me, Dmitri Vitsa, if you can spell it. We'll be back again next week, if not sooner.
You're listening to Music Tectonics.